The U.S. monetary system, rooted in fractional reserve banking since the establishment of the first Bank of the United States in 1791, facilitates money creation through lending, profoundly shaping the economy. This system allows banks to generate new money by issuing loans for both real property, such as land, and consumable goods, epitomized by a piece of bubblegum. While both types of lending expand the money supply, the stark dichotomy between the enduring value of real property and the fleeting nature of consumables reveals fundamental flaws in monetary policy. This essay examines how loans for real property, particularly land, create money backed by assets with intrinsic value, contrasted with loans for consumables like bubblegum, which generate debt for items that are consumed and discarded, leaving no lasting value. By comparing land to bubblegum, this analysis highlights the problematic nature of a monetary policy that equates these transactions, arguing that enabling debt creation for ephemeral goods undermines economic stability. Money creation through fractional reserve banking. Fractional reserve banking, formalized in the U.S. in 1791, enables banks to create money by lending beyond their reserves, holding only a fraction, typically 10% or less, as required by the Federal Reserve. When a bank issues a loan, it credits the borrower's account with a new deposit, increasing the money supply, which reached $21,560 billion in M2, currency, checking accounts, and savings, in January 2025. This process applies equally to loans for real property, defined as tangible, durable assets like land or houses, and consumables, non-durable goods like bubblegum that are used up quickly. The Federal Reserve oversees this system, ensuring liquidity while managing inflation risks, but the equivalence of these lending practices under current policy raises critical concerns. Real property, land and its intrinsic value. When an individual secures a loan to purchase real property, such as a plot of land valued at $300,000, the bank creates a deposit of that amount, which is used to pay the seller. This new money enters circulation, and the seller's bank can lend out a portion of the deposit, further expanding the money supply. Land, as real property, possesses intrinsic value independent of the monetary system. Its finite nature, utility for agriculture, housing, or commerce, and historical appreciation ensure it retains worth, even in economic crises. If the borrower defaults, the bank can repossess the land, recovering value due to its enduring presence. This collateral ties the created money to an asset that persists, potentially stabilizing the currency by anchoring it to tangible wealth. Historically, land has been a cornerstone of economic stability. Before 1791, colonial Americans often homesteaded land without loans, reflecting its accessibility and inherent value. Today, real estate constitutes a significant portion of the U.S. net worth, estimated at $150 to $200 trillion in 2025, with $48,200 billion in household real estate alone. Loans for land align money creation with assets that endure, suggesting a monetary policy that prioritizes such lending could strengthen currency value by linking it to stable, appreciating wealth. Consumables, the ephemeral nature of bubblegum. In stark contrast, purchasing a consumable like a $1 piece of bubblegum with a credit card also creates money through lending. The bank pays the merchant, crediting their account with a new deposit, while the consumer incurs debt. This transaction increases the money supply, but the bubblegum, once chewed and discarded, leaves no lasting value. Unlike land, which remains fixed and reusable, the consumable vanishes, offering no collateral to back the debt, only the borrower's promise to repay. The money created persists as debt, but the item it purchased is gone forever, contributing nothing to the economy's wealth. This practice is pervasive, with credit card debt forming part of the $20,400 billion in household debt in 2024. While a single bubblegum purchase has a negligible impact, widespread borrowing for consumables, food, entertainment, or disposable goods accumulates significant debt without building durable assets. In 1791, borrowing was minimal and focused on trade or land, as consumables were often bartered or bought with scarce currency. The modern ability to borrow for ephemeral goods marks a shift, enabled by fractional reserve banking, that divorces money creation from lasting value. The dichotomy and flaws in monetary policy. The dichotomy between lending for land and bubblegum underscores a critical flaw in U.S. monetary policy. Treating all debt creation as equal, regardless of the asset's durability, undermines economic stability. Loans for real property like land create money backed by assets with intrinsic, enduring value, which can appreciate and support currency stability. If lending were restricted to such assets, the money supply, $21,560 billion in 2025, might be more closely tied to tangible wealth, reducing inflation risks. Conversely, loans for consumables like bubblegum generate debt for items that vanish, leaving only liabilities. This practice inflates the money supply without contributing to the economy's productive capacity, the maximum output of goods and services, potentially devaluing the currency through inflation. Excessive money creation, particularly for consumables, risks diminishing returns. If the money supply grows faster than economic output, each dollar buys less, as seen in hyperinflation cases like Weimar Germany or modern Venezuela. While real property loans can create asset bubbles, as in the 2008 housing crisis, they at least involve assets that persist and can recover value. Consumable debt, however, offers no such recourse, accumulating liabilities that burden borrowers and the economy without adding wealth. The Federal Reserve's role in managing the money supply, including through buying treasury bonds, aims to stabilize markets, but it does not address the fundamental inequity of equating land and bubblegum in money creation. Implications for monetary policy reform. The over-the-top comparison of land to bubblegum highlights the absurdity of a monetary policy that permits unlimited debt creation for disposable goods. Land, with its permanent presence and intrinsic worth, represents a stable foundation for money creation, aligning with the economy's tangible wealth, valued at $150 to $200 trillion nationally and $500 to $600 trillion globally in 2025. Bubblegum, consumed and discarded, symbolizes a policy flaw where money is created for transient value, leaving debt that lingers without purpose. This dichotomy suggests a need for reform, such as prioritizing lending for real property or imposing stricter limits on unsecured consumer debt, to align money creation with assets that endure. In conclusion, the U.S. monetary system's fractional reserve banking creates money through loans for both real property and consumables, but the contrast between land's lasting value and bubblegum's ephemerality reveals a flawed policy. Lending for land ties money to assets with intrinsic worth, supporting currency stability, while borrowing for consumables generates debt for items that vanish, risking inflation and economic imbalance. By equating these transactions, current policy undermines the currency's value, calling for a re-evaluation to prioritize lending that builds lasting wealth over debt for disposable goods.